wasn't fundamentals. This was forced behavior. What you felt over the last sessions, the whipsaws, the failed bounces, the sudden gaps, the volume that appeared out of nowhere. That wasn't a market discovering value. That was a market being moved by rules. And when rules take over, the experience becomes physical. Nausea, screen staring, decision paralysis. That's not a weakness. That's your nervous system detecting structural stress, because something shifted under the hood. Not a headline, not a speech, not a data print. Positioning changed, pressure changed, shorts started changing hands, physical flows began tightening, and leverage started talking louder than opinion. We measure, we don't gamble. Over 10 to 14 days, this market enters a decision window. In a minute, I'll show you the signal that tells you whether this was positioning or a trap. The market didn't speak, it showed its teeth. To understand what actually happened, you have to step away from headlines and into how futures markets really move prices. These markets are not auctions of belief. They are leverage engines. Margin requirements determine who can stay. Open interest tells you who is trapped. Dealers hedge exposure. Commercials offset inventory risk. Funds follow volatility rules. Price emerges from how these participants are forced to behave under those constraints. When positioning shifts quickly, it leaves fingerprints. Falling open interest combined with wide candles usually signals positions being closed, not new conviction being built. But there are two very different closures. Short covering tends to compress ranges after the spike. Liquidation, by contrast, stretches them because sellers are not choosing levels, they are meeting margin calls. Large banks and institutions in this environment are not making moral statements. They are managing balance sheets. Shorts are not opinions. They are tools used to hedge inventory, smooth cash flow, and satisfy regulatory capital math. When volatility rises or liquidity thins, those tools get resized, sometimes abruptly. Thin liquidity is what turns ordinary rebalancing into apparent chaos. When order books are light, even modest forced orders can gap price, trip stops, and cascade into more mechanical selling. That is why this move didn't feel proportional. And here's the part most miss. Physical accumulation does not need higher prices first. Paper often clears before physical reprices. Risk is reduced on screens before necessity shows up in warehouses very soon here. Why? It felt violent. Forced selling. Plus, liquidity. If this feels violent, that reaction is not emotional excess. It is rational. Fear increases when rules change because the brain is built to detect environments where cause and effect no longer look familiar. And during this move, cause and effect were not being driven by choice. They were being driven by obligation. In stressed markets, the most powerful sellers are not pessimists. They are accounts, answering margin calls, volatility targeting funds, cutting exposure automatically, and dealers adjusting hedges as options gamma shifts against them. None of these participants are negotiating with price. They are complying with formulas. That is what creates the sense of being overrun. This is where liquidity becomes the story. When participation matters, markets do not glide from level to level. They jump. Candles stretch, not because conviction has deepened, but because there are fewer resting orders to absorb what is being pushed through. A small imbalance in a deep book is noise. The same imbalance in a shallow book becomes a headline. Stops, then compound it. As levels break, protective orders convert into market orders. Options hedging compounds it further, as dealers are forced to sell into weakness or buy into strength to stay neutral. The chart begins to feed on itself. Narratives follow after the fact, trying to retrofit meaning onto what was already finished. And all of this happens on screens designed to capture attention. Red flashes, speed, constant updating. The environment itself becomes a psychological weapon, pulling focus toward every tick away from structure. What you're often seeing near these moments is mechanical exhaustion. The market expends forced energy. When that energy burns off, what follows is rarely gentle. It is either a deceptive calm that traps late emotion, or a reversal that feels just as unfair as the drop. In the next section, we separate what we know from what we are projecting. Facts versus interpretation, credibility ladder. Now we slow this down and separate what can be observed from what is being assumed, because credibility in environments like this comes from discipline, not confidence. Fact: price moved violently, ranges expanded, volume surged, open interest contracted. Those are not opinions, they are measurable. They tell us participation changed and positions were being closed, not simply shifted at the margins. Interpretation: that pattern most often accompanies forced behavior. It suggests pressure release rather than fresh directional commitment. It raises the probability that something mechanical was resolved, even if something structural is still building. Fact: inventory reports have begun to show uneven movement. Delivery notices have not disappeared. Some ETFs have seen flows that do not cleanly match the intraday drama. Interpretation: stress in those areas often precedes repricing elsewhere. Physical systems move slower than screens, but they do not move randomly. When they tighten, paper tends to react later. Fact: Historically, large banks and commercials adjust exposure before conditions become obvious to the public. They reduce risk when volatility rises, when funding costs shift, when balance sheet math changes. Interpretation: institutions usually reposition before repricing, not after it. They manage vulnerability first. They chase the narrative later. This is where uncertainty and discipline matters. We deal in probabilities, not prophecy. Facts anchor us. Interpretation guides us. And next, we map the exact zones where behavior, not headlines, will decide what this move actually was. The decision zone, key levels, plus behavior at levels. What matters now is not where price has been, but where behavior begins to change. This is what we call the decision zone. It is not a single number on a chart. It is a region where forced behavior either exhausts itself or transitions into something more deliberate. Stabilization in this zone has a specific feel. Ranges begin to narrow. Attempts to push price lower stop traveling as far. Volume remains present, but it loses its desperation. You start to see time replace speed. Rejection, by contrast, looks like brief pauses followed by renewed air pockets, where price cannot hold even temporary ground before liquidity disappears again. Volume at inflection points is not about spikes, it is about response. Healthy absorption shows up when heavy trade fails to move price as much as it did before. That tells you someone is willing to take the other side without being forced. If accumulation is real, open interest should stop collapsing. It may even begin to rebuild quietly as positions are established rather than closed. Failure in this zone usually triggers a different class of selling. Not emotional selling, but structural selling. Trend systems re-engage. Risk models downshift. Capital that had been waiting for stability withdraws. That is when moves regain speed without news. This is why sideways behavior after violence is often more important than any dramatic bounce. Breakouts are easy to see. Negotiations are not. The market decides its next character here, through acceptance or refusal. This is not a place for prediction. It is a place for observation. Because what happens in this zone tells you whether paper stress is resolving or simply relocating. And in a minute, we step away from charts entirely, into the real market, where there is a tell the screen never shows. Section 6, paper versus physical, premiums, inventory, delivery. This is where analysis has to leave the screen and enter the real market, because paper pricing and physical reality are related, but they are not the same system. Futures and derivatives are primarily tools for transferring risk. Physical metal is a tool for meeting necessity. One trades expectations, the other satisfies demand. Premiums are the first place this difference shows up. When paper prices fall, but premiums stop falling or begin rising, that is not noise. It suggests that the marginal seller exists on the screen, not in the supply chain. Premiums widen when sourcing becomes harder, when logistics tighten, when counterparties become selective. They are not driven by opinion, they are driven by availability. Inventory is similar. Headline tonnage can stay flat while usable supply shrinks. Bars can be spoken for. Eligible metal can become functionally unavailable. Drawdowns do not always announce themselves loudly. Sometimes they appear as longer delivery times, restricted product lines, or quiet shifts in what dealers are willing to quote. Delivery behavior matters for the same reason. Who stands? Who rolls? Who suddenly prefers settlement outside the visible auction? Those choices reveal whether participants are interacting with metal or merely with contracts. Retail shortages usually lag this process. Wholesale tightness comes first. Refiners, mints, industrial users. Then the stress trickles outward. That is why physical accumulation can rise even while paper price is under pressure. Institutions reduce paper exposure to manage balance sheet risk while increasing physical access to manage operational risk. When paper weakens and physical signals refuse to confirm, that divergence becomes an early warning system. Not a prediction, a condition. And now we map the three paths forward because only one aligns cleanly with rising physical stress. Scenario map, breakout versus fakeout versus washout. From here, the market doesn't offer answers. It offers paths. And paths are navigated through conditions, not conviction. There are three that matter. The first is a breakout path. This is not defined by a single green candle. It is defined by behavior. Price stabilizes, pullbacks shorten. Open interest stops bleeding and begins to rise, not explosively, but persistently. That suggests new positions are being built, not old ones being forced out. At the same time, physical premiums would tend to firm rather than compress, indicating that paper relief is not loosening real-world demand. In this environment, volatility contracts before expansion. Institutions would be expected to slowly reintroduce exposure, not chase it. Psychology shifts from panic to impatience. Boredom replaces fear. That boredom is often the soil in which sustainable trends grow. The second path is a fake-out. This is the most emotionally efficient outcome for markets because it satisfies hope without resolving structure. Price lifts sharply, but volume fades. Spreads widen. Liquidity thins again. Open interest fails to rebuild in a healthy way, or worse, continues to decline. The rally feels good, but it is not being sponsored. Physical signals would tend to soften here, with premiums easing and delivery pressure remaining muted. This path often seduces capital back, and just as structural sellers regain room to operate. Psychologically, it replaces fear with relief. That relief is what creates vulnerability. And the third path is the washout then higher scenario. This is the least comfortable and often the most mechanically honest. It involves one more phase of forced liquidation, another volatility spike, another sense of unfairness. But beneath that surface, absorption begins. You would look for heavy trade that no longer produces proportionate movement, for open interest collapse that finally slows, for physical indicators that refuse to weaken even as screens do. Institutions in this phase are not advertising intent. They are completing risk transfer. Emotionally, this path produces resignation before it produces stability. Time is what separates these. Breakouts built on structure take time. Fakeouts seek speed. Washouts exhaust it. None of these announce themselves. They evolve through behavior. We don't need certainty. We need alignment. And next, we talk about how professionals survive uncertainty because structure matters more than conviction. Risk, discipline, and positioning mindset. This is the point where the conversation shifts from markets to operators because there is a fundamental difference between speculation and risk management. Speculation asks what might happen. Risk management asks what can break you if you're wrong. In volatile environments, that distinction becomes survival. Speculation seeks stimulation. Risk management seeks continuity. One of the most counterintuitive truths in this business is that correct positioning often feels boring. When exposure is aligned with structure, there is less impulse to check every tick, less emotional whiplash, less need for constant explanation. The mind wants drama, the process wants stability. When boredom appears, it often means that decisions were made before urgency arrived. The danger is narrative attachment. Stories are comforting. They give chaos a face. But when you marry a narrative, you outsource perception. You begin to filter information instead of measuring it. Stress, in contrast, is not an enemy. It is information. It tells you where sensitivity exists, where leverage is concentrated, where structure is fragile. Cash, metals, and patience are not ideologies. They are tools. Each has a function. Each creates optionality. The mistake is turning any of them into identity, because identity resists adjustment. Risk management requires it. Screens are engineered for hypnosis. Constant movement creates the illusion of necessity. Decision windows do not. They are quiet. They stretch. They invite observation rather than reaction. This is one of them. The next section is your signal checklist. These are the tells institutions watch, because calm is not passive. It is tactical. What to watch next? Signals checklist plus time window. From here, attention shifts from interpretation to monitoring, because the next 10 to 14 days form a second decision window. This is where structure either confirms itself or reveals that pressure is unfinished. Open interest is first, not the number itself, but its behavior. Continued contraction suggests liquidation is still resolving. Stabilization followed by slow rebuilding suggests positions are being established rather than removed. That distinction matters more than price. Margins and volatility controls come next. Rule changes alter who is allowed to exist in the market. A hike forces exposure out. A relaxation invites it back. These are not opinions. They are switches. When they flip, behavior follows. Inventory and delivery notices tell a slower story but a heavier one. Watch not only headline totals but patterns. Who stands? Who rolls? How often settlement drifts away from the visible auction? These subtleties reveal whether metal is being treated as a financial placeholder or as an operational necessity. Physical premiums and wait times translate this into the real economy. They are friction indicators. When paper calms but premiums refuse, stress is migrating, not disappearing. Liquidity conditions and spreads reveal whether participation is returning. Healthy markets narrow spreads before they trend. Fragile ones trend before they stabilize. Correlation breaks matter too. When silver stops moving with the dollar, with yields, or even with miners, it suggests internal forces are overtaking macro noise. Commitment-style positioning shifts, when available, provide context for all of it, not as a prophecy, as a probability. Journal what you see. Patterns reveal themselves in sequence. One of these signals almost always moves first, and when it does, speed follows, because signals whisper before price screams. So where does that leave us? We've walked through why this move was driven by forced behavior, not fundamentals. We've mapped the decision zone where the next character of this market is being negotiated. And we've shifted focus from charts to physical tells, where real stress either confirms or denies what screens are suggesting. Now I want to turn this back to you. Which signal are you watching most closely right now? Is it open interest? Physical premiums? Delivery behavior? Liquidity? Or correlations beginning to fail? And second, Based on what you're seeing, do you think this market is building stability? Or do you believe one more forced flush is required before anything durable can form? Share that below. Not predictions, observations. If this kind of crisis-style market briefing is useful to you, subscribe. Not for excitement, for continuity. These conditions don't resolve in a day. They evolve. Because if margins shift again while price is stabilizing, the next move may not look like the last. We don't chase markets. We watch them confess.